morning, Janela. So I think what we learned is that we are in a new regime where the end of easy money brings fundamentals, and it's kind of forcing investors to differentiate between what has been overly benefiting from easy money, what has been purely speculative, and what still has a fundamental backup, right? So what we've seen in the last couple of weeks is mostly the highly speculative assets being sold, and that's why you're seeing some of the prominent tech stocks underperforming, and investors somewhat starting to shift towards the old economy part of the market, which has been less exciting in the last couple of years, but still has more support from fundamental and less impact from this unwind of liquidity.
Well, Emmanuel, we're now part of the way through earnings season, and one of the interesting features has been that those companies that have disappointed seem to be getting hit really hard. But on the other hand, companies that have beat expectations aren't benefiting hugely. What's your take on earnings season so far, and what can we take away from that market to action?
Look, so the selling, I think, in January was very indiscriminate, right? So the market was very binary. And roughly speaking, the kind of expensive growth stocks were sold, and the cheaper value names have outperformed. We're very early days in the reporting season, but I do believe that the reporting season will force investors to differentiate more based on the fundamentals, maybe less about factor and sector tilt. So far, the early numbers are quite good. We are seeing a majority of companies beating estimates in Europe and the US, less than it was the case in the last few quarters. But I guess that should be expected with the earnings cycle normalizing to some extent. And as you said, the market, the price action has been fairly negative overall to the numbers. But we do believe that it is still important that to put the kind of sell-off in a more kind of fundamental backdrop. And for now, we do find earnings somewhat reassuring that, yes, the market is nervous about the end of easy money policy normalization, but earnings fundamental are still telling us that growth is fine, demand is okay, less costs are going up, and that's an issue for margins. But overall, we still see the corporate sector able to provide some stability to the equity market.
And Emmanuel, looking back at the month of January, the UK market stands out as the key outperformer. FTSE 100 up about 1.5% for the month at this point. What do you think of the UK versus the rest of Europe going into the rest of the year?
I think relative value is still a big support to the UK equity market. It's cheap. It's been cheap for a long, long time, by the way. I think the sector composition has been perfect. UK is a defensive value index. We have a lot of banks, we have a lot of commodities, which have been performing very well in the last couple of weeks. But the UK market also has defensive sector like utilities, telecom, which are a bit more in vogue again, right? So the mix of value and defensive composition is a support to the market. And UK is one of the few large cap indices which has no tech in its composition. So this is a key index to play the rotation. Now, I think the question is whether this rotation will continue or not. We think it will moderate. We have an extreme value growth of performance in January, 11%, the highest in 30 years. Probably from here, if yields stabilize, we do think that the value growth performance will be less extreme than it has been, which in the UK market short term might struggle to perform as much as it did in the last couple of weeks compared to other indices.